think on the positive side, though, is you're seeing capital markets, open for the resource sector. You're seeing a lot of money flowing in, and so I think that gives you some encouragement that the projects will be funded.
I think the key to transforming an explorer into a miner has got a lot to do with the project, but it's got everything to do with being able to fund yourself through that big development step, which can sometimes mean multiplying your market cap in a raising.
The best hedge against inflation is gold, and I think that'll play out over the course of this year, that as we see those inflationary expectations increase once again, that we'll see gold as the core inflation hedge, start to see investment start to come back in the space.
What we're always looking for is companies with their own internal drivers outside of just the broader commodity cycle. So where's their production upside? Where is their potential M&A growth or other growth avenues that the market's not onto?
Good morning, everyone, and welcome to another one-to-one mining investment APAC online content session. Today, we have our investment leaders panel, which features David Franklyn, Head of Funds Management at Argonaut, Matt Griffin, Co-Portfolio Manager, Small Caps at AMP Capital, Luke Smith, Portfolio Manager, Global Resources at Ausbil Investment Management, and Hedley Widdup, Manager for Lion Selection Group. So thank you everyone for taking part today. This is a live webinar, so we want to encourage everyone from the audience to ask questions to our panelists. You can put in the questions in the Q&A box at the bottom of the Zoom screen. And also, I want to remind everyone that all of the investors that are listening in today to please reach out if you need any help setting up your meetings for the event, which starts tomorrow. And so to kick things off, I want to ask our panel of investors, what are the types of projects that you're seeing getting funded at the moment? Where are investors such as yourselves seeing the most value? So maybe Luke, if you'd like to kick us off there.
Yeah, sure. I guess not enough is probably the starting answer. We haven't seen enough projects invested in for the last decade or so since we saw the last super cycle, and I think that's one of the key features that's feeding into such a supportive environment for commodities is that the majors are really focused on repairing balance sheets, returning capital to shareholders, and sure, we're seeing a step up in activity in general in recent years, but this cycle is set up extremely well from the perspective that we just haven't seen enough investment in on the supply side, and these are large scale projects that are needed in a backdrop that's supportive from a demand perspective.
Can I add to that? Oh, sorry, go on, David.
Thanks, Hedley. Look, I agree. I mean, I think there's obviously a catch-up that's taking place. I think on the positive side, though, is you're seeing capital markets, open for the resource sector. You're seeing a lot of money flowing in, and so I think that gives you some encouragement that the projects will be funded, and and that situation will turn around.
I'd sort of add to that as well, Amy, some sentiment that if you were to compare today to, say, 3 or even 5 years ago, projects getting funded at the moment is probably a much more broad basket, albeit still narrow, than it has been. Investors' money coming into the mining market, I think maybe 5 years ago, was seeking some of the bigger miners, and it might have been commodities focused. Some stages over the last 3 years, gold's been quite hot, so that's attracted investors to the miners. I think a lot of that sentiment has almost trickled down now. So as people go pursuing returns and prepared to take a bit of risk, finds its way into different commodity sectors, but also into smaller companies. So when you ask the question about where investors see most value, I think maybe value is not the concept, perhaps potential price performance is, and they're looking for things where there might be some excitement as opposed to steady delivery of earnings and then dividends. So I'd say a whole sentiment shift has taken place there.
I'll chip in. I'll agree with Hedley on that. I think it's very broad based at the moment. I mean, you're seeing pretty much every type of commodity company being able to raise money. The exception may be coal, just on ESG concerns. But particularly the junior end, if you look at junior capital raisings on the ASX and the TSX, we're almost back to levels last seen kind of a decade ago. We had the last sort of proper exploration boom. That's really feeding through into some of the things we're seeing from drillers and exploration companies out there. We've yet to really see, as Luke said, kind of the bigger companies finance larger projects. I do think there's a wave of sort of small and mid-tier companies coming through financing now. So there'll probably be a bit of a mini sort of construction boom heading into next year. But, echoing what Luke said, the majors still very much in cash preservation mode and capital management. So yet to see things on a big scale, but there's certainly a lot of activity bubbling up around the small end of the market.
I'd certainly say that the majors are growth oriented in their mindset, as much as I totally agree with the concept that repairing balance sheets and probably not wanting to repair some of the mistakes of the past, but there's a number of signals that they're prepared to invest in more risky endeavours, and we've seen many of them commit to exploration. Winu in Rio Tinto is a great success story of the last few years. It certainly isn't even a long-term theme, that one, which has seen money put into the ground by Rio to discover a new project, and we'll see how that goes in terms of development. But that would have been something which would not be attainable, I would say, in the market of, say, 2011 through to 15 by a company the likes of that. So, and from there, the appetite for M&A, we're seeing some of that, particularly in the gold space, but the appetite for project development will flow from that as well, particularly as new projects are added to the pipeline.
Amy, maybe the other point is just, on where investors seeing most value. I think what's really interesting about the market at the moment is there's a fair portion of the market, of the investors, that are focused more on themes and value. The role of the retail investor and the role of passive investments, and particularly ETFs, which are driven by themes, means that there's a lot of money flowing around. And it's not necessarily driven by fundamental analysis, and that's had a real impact on stocks and sectors, which I think is interesting.
A great example of that, David, might be the phenomenon that was gold in 2020, which almost seems at the flick of a tweet button by someone like Elon Musk to bring it back into battery-focused commodities even. I suspect that probably the commodity fundamentals were brewing for that move, but as the spotlight gets shifted from one place to the other, it's amazing to see how a herd can stampede from one place to the other in the market. And we've seen, I think the Australian gold index is down about 33% since August last year, which was more or less the peak of the gold price. That money's gone somewhere, and it seems to have inflated or reflated perhaps some of the, I won't use the expression bubbles, but the balloons of value that expand and contract around some of the other thematics.
Yeah.
And I guess to your point, Hedley, what we've seen more recently, is this shift towards battery materials. It feels like there's capital raising every day at the moment around battery materials. Last year it was the gold space, but it's not just the resources funds that are investing in this space anymore. And to David's point, is sort of theme-based investing. These ESG funds, there's a flow of money coming into these funds, and what's driving them is pushing them further upstream towards the miners as well, and that'll feed into lithium names, the graphite names, but we're also seeing it feed even further down the list into potentially clean copper names or otherwise. One of the probably additions that it feeds into it, with a group of investors that are less focused on valuation potentially and more focused on this broad theme is that it's adding a bit more volatility to the space. Not only are resources back in vogue to some degree, but certainly we're seeing more volatility in some of the space because of the lack of knowledge and that is being put to work in some of this investing.
The other interesting thing there is just the size of capital raisings. There's some chunky raisings out there, particularly in that lithium EV type space. We saw a couple, about a month ago here with Vulcan Energy, Ecograph raising 50, 100 mil plus. And these are projects which, a couple of years ago, they were minnows with $1 billion capex bills, very hard to finance. But now that there's that size of raising around, it really does make that whole financing piece a lot easier for these companies. So particularly some of these juniors which would have struggled to get into production now have a better line of sight there. There's still obviously a big debt component and probably further equity down the track, but the market is supporting these things. So that probably does go towards the building pipeline of construction projects out there.
Which I think probably speaks to where investors will see value too, Matt, because I think the key to transforming an explorer into a miner has got a lot to do with the project, but it's got everything to do with being able to fund yourself through that big development step, which can sometimes mean multiplying your market cap in a raising. And if that liquidity doesn't exist, then it's just not going to happen. There's no ways you can finesse that any other way. So in stages in the market like we're in now, that makes it possible to unlock that value in those undeveloped projects in juniors. But you know that likewise could be seen as juniors grow, the majors will want to as well. They'll want to be growth oriented, as I said before, which will push them down the path of looking at how do we grow production, or how do we dominate a space better by taking over some of our smaller companies in the space.
And I guess continuing on from that, what are some of the kind of the broader macroeconomic factors that you've seen helping to shape the various investment decisions, either by yourself or your peers in the market these days? What are those influences that are kind of impacting those? Maybe David, I don't know if you want to kick us off there.
Yeah, look, I think I'll highlight two factors. One is obviously as we come out of the COVID situation, there's really a coordinated global stimulus to the economy. So a lot of money being pumped in. That's very supportive of commodities, commodity demand, but also providing funding for commodity projects. So I think that's really the key, I think, and that's what's giving people confidence in the sector. And then we touched on the whole ESG theme, and I think that, if you're looking at one theme for the next decade, that's it. So that encompasses electric vehicles, the decarbonisation of power. I think the mind shift has taken place where people are saying, rather than is this going to happen, it's if and when. It's so people are, and then how quickly penetration rates of electric vehicles will happen. So, I think there's a real tipping point that we're at, and I think you're seeing funds flow into that ESG sector, and I think that'll continue for the next decade.
Yeah, I guess expanding on a couple of those points, or the first point that David made, starting with demand, China clearly, put the hammer down post-COVID, got activity levels back extremely quickly. Clearly China dominates commodities demand, and that's the real backbone that's driven us into the situation at the moment. So China's more, I guess, around, at least at the early stages, around construction, commodities, construction-related commodities, steel, iron ore, met coal, I guess, as a starting point. But then, feeds into the base metals as well beyond that, later cycle commodities. Now what we're seeing is as the vaccine rolls out at an accelerated pace, I don't think the mainstream media wants to focus on how quickly this vaccine is going to get economies back to normal. Some of the stats are incredible. You're seeing out of the US and UK in particular. You throw to David's point around unprecedented levels of stimulus. So as we come out of this vaccine, we're going to see the rest of the world really, start accelerating. And it's a feature that we haven't seen for the last decade is that, China has been so dominant in commodities demand that the rest of the world is really going to start accelerating through the course of this year. And that's the demand side. To the point that I sort of made earlier around supply, we've seen no investment, new supply for the last decade. Last year we had a couple of COVID-related issues in South America in iron ore and copper, and you've seen what's happened to those two commodities. The demand backdrop wasn't strong for copper through the course of last year, and we had a commodity double in the last 12 months. It's incredible. And then some of the other key themes that are coming out of late, as you print money, as you see the US print money, seen a devaluation of the US dollar that's supportive of commodities, and really in the last couple of months, a theme that I think is really going to be a dominant force when we're talking about resource investing is inflation. Conventional portfolios are not set up for inflation. If we do, like we've seen with what's played out with bond yields in the last couple of months, is it highlights that growth is extremely strong. The Fed's highlighted that they're willing to let inflation run beyond 2%. Whether or not we see that or not, I haven't seen it in my investment sort of career, but whether or not we see it or not is irrelevant. Portfolios are not set up for inflation, and resources are really going to be back in vogue, because it's one of the only ways to protect these portfolios against inflation. And there's a range of fundamental factors, obviously, like I talked to, on supply and demand that are supportive for commodities and resources. But this sort of inflationary aspect is something that's going to drive this space for some time from our perspective.
Some of you big boy institutions might have to get some gold in those portfolios. Luke, what do you reckon?
Yeah, well, like saying, there's a high correlation between gold and resources. So it's interesting, the move that we've seen in gold in the last couple of months. I think it's sort of ignoring the fact that, like you're saying, that the best hedge against inflation is gold, and I think that'll play out over the course of this year. That as we see those inflationary expectations increase once again, that we'll see gold as the core inflation hedge. Start to see investment start to come back in the space. And look, commodities still strong. It's just the equities that have been under some pressure. And then secondarily, like I said, I think this whole resources space is a great way for broader portfolios to protect against inflation as well.
There's an interesting point in that, Luke, that you make there around how gold has performed, and interesting the way that it's kind of softened against I suppose a longer term fundamental outlook. I often wonder with gold, when an interest rate perspective changes, gold moves because it's an instantaneous enough thing. When the perception towards inflation changes, it often takes a while for that to kick in with gold. But when you see the rubber hit the road and the inflation numbers come out, that's when it starts to move. So like you say, if we're in the latter half of this year and starting to see stimulus rolling out, people emerging from lockdown, spending money that's been pent up in their savings because they haven't been able to spend it, in a market which is deprived of goods because production has slowed, then it's easy to see inflation starting to take place against that sort of a backdrop, which I think it benefits most commodities, but gold will often be a harbinger of that as it starts to move.
Yeah.
Just on the macro theme, Amy, that you asked about, I mean, quite a few of us have just talked about demand, and demand is, a long-term growth story. I think when you talk about just about all mineral commodities, in something like copper, in the last 25 or 26 years, I think the world has consumed half of the copper that's ever been mined. So, there's a huge incremental growth that takes place as time goes on, and there is going to have to be more of it because we keep consuming it. But it's got to come out of the ground somewhere. And Matt started this panel, I think, by saying that there's been very little investment in future projects. So the existing resources and reserves aren't going to meet that demand, and there hasn't been any more brought to production, or very small amount in recent years. And I think as demand grows, we'll start to see supply really kick in as a driver of prices. So, the boom that took us to about 2007, 2008 was about China becoming a much larger consumer of commodities. And I think the boom that we're in, and perhaps the next one, will be defined by supply being very slow to catch up of that lack of investment that's taken place over the last decade.
I think one of the interesting things going forward is going to be the supply-demand dynamics in some of the smaller, high-growth markets. I mean, you look at lithium, nickel, rare earths, it's pretty hard to pin down a good demand forecast. I mean, everyone's kind of having a stab at it, but you've got huge ranges in where demand's going to end up over the next 5 or 10 years. And the supply side, there was probably too much supply 2 or 3 years ago in these commodities, which is why there was a big correction. We've now come into a period where inventories are running down, mines can't keep up. So we're seeing these prices spike pretty rapidly, and that probably continues until supply comes back online. But we all know there's no shortage of lithium projects out there. There's no shortage of nickel out there either. The nickel dynamic a couple of weeks ago was interesting when Tsingshan came out and said they've got massive supply growth in the pipeline caused the nickel price to correct 15% almost overnight. So I think it's going to be a volatile ride for some of those smaller markets. The demand dynamics are definitely there. It just depends on the speed of the take-up. But I think what we can see is there is a lot of supply coming in those areas. Will it be enough, and will it come soon enough? Probably not in the short term, but it is certainly going to be interesting 2 or 3 years ahead, I think, in those areas.
Yeah, I mean, I think you're right. I mean, I think what you've seen is commodity prices until recently had been pretty subdued, and the future demand outlook was reasonably uncertain, and so projects haven't kicked off. But I think you're right. There's a scrambling now with money coming into the market and activity, and commodity prices starting to move. That I guess give people confidence that they can commit capital. I think it's a good point.
I know on the batteries theme, there's been a lot of kind of projected demand for the various metals that will go into EVs and batteries. Kind of where do you see this the supply being able to meet up with the demand, and where do you see that really coming from?
Yeah, I'll kick that off. I think my base thesis probably is if we look at lithium as potentially the main battery materials commodity, there definitely seems to be a short-term shortage there. So I probably see the prices spiking up further and probably beyond what they should be fundamentally in the long term. That will spur a lot of investment, though, and like we've discussed in a couple of previous questions, we have seen a lot of raisings committed to that space. We're seeing projects go ahead. A lot of these companies are dusting off feasibility studies they did 2 or 3 years ago in the last lithium boom. So the supply is definitely coming. It's probably not going to quite be there in the short term. I think medium term, there does seem to be enough lithium out there to satisfy demand, even on fairly bullish projections. But you obviously need a pretty good incentive price to get that. So for spodumene, you probably need $600 or $700 to actually incentivize that production to come to market. I think where we're getting more interested is in some of the other battery materials, things like graphite. There's probably better supply demand dynamics there, and you've got a lot of Chinese domestic production, not much Western world. That's a different thematic playing out as well, where car manufacturers, battery makers are looking to diversify away from China a bit, just to get rid of a bit of that risk. And obviously the geopolitical tensions happening between China and the US. So we're probably turning the focus more from lithium to some of the other commodities in that space, where supply does look a bit more challenged on a medium-term view.
It's a very interesting market to assess, because when you think about something like the iron ore market, enormous market, and a small project coming online is unlikely to, well, it's hard to do a small project in iron ore, so it's a silly example really, but a small project coming online doesn't add much in terms of the broader production. It's hard to affect the supply-demand balance through just something new coming on like that. But something like lithium or graphite even, they're small markets which in some cases are dominated by either a large production hub or 1 or 2 large projects. So new things coming on, and often it has to be the biggest and most exciting to get funded, can move the needle quite significantly. But also, I mean, it's possible in a market which is in the future going to be dominated by projects which aren't producing yet, for those future consumers to influence how those projects come through in delivering offtake agreements and participating perhaps in some potential funding for the projects. So, I mean, I don't want to sound conspiratorial about it, but I would be certain that some of those off-takers are sitting there thinking, how do we get access to the most possible product? And is there a way that we can overcommit, which might engineer oversupply? It's going to be better for them in the long term in terms of taking the price that they do. So as a consumer, it would be fantastic. But it's a sensitive market, was the point that I'm trying to make. And particularly as these are growing to become more mainstream, I think the problems which Matt's talking about there are going to play out from year to year. But longer term, the thematic of batteries, it's a wonderful one. I think the issue really for investors is not about will there be a market for these commodities. It's more, we don't know as much about what the quality constraints are at site at a mining project to get the best possible product into the market as we do for something like iron ore or coal or anything like that. So there's a few learnings for investors to take, and it's a question of where in the queue that project that they're thinking about getting involved with, particularly if they're taking a risk approach and saying, how do I get in more cheaply? Where is that going to sit in the queue of being commercialised and brought to market?
Yeah,
I guess that. Sorry, David.
Sorry, you go.
Yeah, I guess the point I was going to sort of reinforce and it's probably around the demand side that's different to 3 or 4 years ago. And it's always wary when someone says it's different this time, because clearly supply is going to respond with what's playing out with demand. But I guess the difference to the cycle that we saw 3 or 4 years ago is that demand was driven by subsidies in China. And what we're seeing play out around electric vehicles at the moment, one is Chinese demand has recovered, and electric vehicle, sort of consumption has accelerated materially, excuse the pun, through the course of last year. And then, the green stimulus that we saw come through in Europe last year post-COVID, has meant that, we've arrived in terms of the destination for European demand. European demand exceeded Chinese last year. Incredible amount of growth that came through. The next leg of demand growth clearly is a discussion around US, but I think that's probably a more medium-term discussion. But where the demand backdrop sits a little bit differently in terms of the discussion we're having electric vehicles and what it means for commodities consumption is that it's not just, once again, a China story, that the penetration that we're seeing in Europe is amazing. Like, it's incredible. We've arrived at that destination. We had the VW Power Day last night, obviously, and again, reinforced the amount of electric vehicles that these producers are talking about pushing out in over the medium term, and that's the starting point. Supply will clearly respond. It needs pricing to strengthen or continue to strengthen to support it. And we'll go through another one of these cycles. But in terms of the demand backdrop, we're in a much different place than we were 4 years ago as the cycle rolled off around EVs. And look, I guess most of the focus around our discussion, is on the direct commodities that are influenced by EV penetration, lithium, graphite, manganese. But this is material for nickel. This is material for base metals and copper as well, across the board. And to some of the early discussion that we're having around lack of investment in new major supply, these finite resources and the base metals, it's just as material to those commodities which aren't seeing the investment as more obvious, in terms of the base metals space, as it is to the purer commodities within the supply chain as well.
It's a good point, Luke. And I guess what I would add to that is I think the EU has really stepped up over the last year. And I think maybe with the change in government in the US, you'll see the US start to commit to that. And so it should, because, green investments are politically popular and also, environmentally necessary and economically stacking up now. So I think there's a lot of support for that theme. I guess it's a shame in Australia that we don't have the same commitment, but that's discussion for another time. I think the big issue going forward is, can the supply chain keep up with the demand outlook? And, I think that, and the logistics associated with that. So I think we will see squeezes in commodity markets as demand exceeds supply, and ultimately we'll probably see supply exceed demand at some point. Finally, the final point I make on all that is just the funding. I mean, I think if you look at what's going on, you've got, particularly in the EV market, you've got a lot of majors making a lot of commitments about their transition. And when you put that into context, if you take Tesla, its market cap is about 860 billion, which is actually more than the entire Australian resource sector, So ultimately, I think if projects aren't happening fast enough, you're going to see some integration from these manufacturers saying, we're going to integrate and start to fund projects to make sure this stuff happens. So I think it's going to be a fascinating decade as we transition.
Amy, before you go on with your next question, I've got one which relates to this topic, which is probably more for these three gents than it is for myself, because I don't know if I know the answer. But I mean, if we live in Australia, all four of us, you're up there in Hong Kong. I mean, if you go out on a long weekend, or we've got the Easter weekend coming up in a few weeks' time, I suspect if you were to drive up the Hume Highway, which I will, you will be surrounded by other vehicles, and you might be able to sit on the speed limit, but you could stick out your hand and probably touch 2 other cars. Most of what you see is going to be a mixture of family cars, petrol powered probably, and a large selection of 4-wheel drives, which are mostly going to be diesel powered. We live in Australia where that's still a ubiquitous sight on motorways and even around town. I mean, what we're hearing just here, and I'm not sure if a lot of investors realise this, but if you were to go to Europe, you're going to see a completely different picture there. Diesel is being phased out quite rapidly. EVs are being phased in quite rapidly. And, here in Australia, investors are influenced by recent political changes, and what they see every day. I see more Teslas in presentations than I see driving around. So, the saturation there is still far from coming. But so question for you guys on the panel is, do you think the Australian market in particular is missing this theme or underestimating it, or a danger of underestimating it? Because clearly it's a big growth story for the future. We're talking about supply and demand, but EVs, battery storage, and all other forms of battery-related technology is coming, and it's coming hard globally. Are we up to speed?
Yeah,
do you want me to allocate that one?
I'll kick off. It's an interesting point. I mean, because Australia does seem to be lagging the rest of the world when it comes to EV policy and adoption and just general green sort of thematics. But I guess what's funny is that, you look at one of the biggest lithium suppliers in the world is Australia, and that's where a lot of the growth in supply is coming from. So is the Australian market missing it a little bit? Probably, just given, it's always hard to visualize what's happening overseas, especially when we can't travel and you don't get the local experience here. But I think what we'll see is if the Australian market doesn't come to the party on investment, I think foreign investors and foreign companies will, just because Australia is one of the lowest cost producers in the world, very stable jurisdiction, and it's needed for supply. So I think the investment will happen whether the Australian market picks up on it or not.
Yeah, what I'd add is I think where we're lacking is government initiative and drive. Corporately, I think we're seeing quite a lot of activity, and and I think the positive is that corporates will drive this. Australia has a huge opportunity, as Matt was saying. We're the largest lithium producer. Good resources of nickel. The best rare earth deposit on the planet. So we should be a global leader, and it remains to be seen whether we will be. More broadly, I think economics wins. People will buy Teslas when it makes sense to do so, and at the moment, perhaps prices are a bit high and distances are a bit long. But I think we'll get there. So I think the trend is happening.
I think that's a good point, David. I mean, in my house, if I want to buy something, there's a person I ask for permission before I go and get a credit card out. And at the moment, she's not interested in a Tesla.
Yeah.
I think the time will come, but we're not quite there yet.
Yeah, exactly.
That's probably one of the key things for EV adoption going forward is actually that cost parity argument, because I think it's been proven that consumers want to be green, want to do the right thing by the environment, but they won't do it if it costs them more than the alternatives. And obviously, one of the things that really kickstarted this latest lithium and EV boom was the European subsidies. We're probably still 3 or 4 years off having full cost parity on an unsubsidized basis for EVs versus petrol engines. And it's going to be interesting. I mean, if we do see spikes in some of these battery material or commodities, does that actually delay the point of cost parity because your battery packs are getting more expensive and therefore EVs are sort of looking less cost competitive relative to petrol engines? So there's a balance to play out there, and I think you still need a level of government subsidy over the next few years to continue that adoption curve until we actually reach the tipping point. We obviously haven't seen it in Australia, but you can see the Europeans are committed to it. That probably keeps going. I think whether the US comes to the party is going to be a big question as well, because that is really one market which should be a lot bigger than it is. And I think it just needs, the consumers need a bit of help there to get over the line on EV adoption.
Yeah, and the interesting point about this whole discussion, you sort of talked about EVs a lot, and I guess the implications that they have for commodities demand as we look forward for the next decade or so. But there's a raft of other areas across the board around these sort of transition of the global economy that are positive for metals. if we're talking about renewables and we're talking about solar and the implications on rare earths or the implications on silver or otherwise, if we're stepping further through the mix and we're talking about hydrogen or the phasing out of diesel and the implications they have on PGMs across the board, but there's as we transition through the global economy, that clearly there's going to be winners and losers in this space, and fossil fuels on a longer term basis are going to be structurally challenged on a simplistic basis. But then, the metals markets are going to benefit from a number of these themes. We've talked at length about EVs, but the metals markets in a range of these sort of transitionary sort of areas are quite supportive for metals markets, and again in environments that that have just seen a lack of investment in new supplies. So the outlook looks rosy for us.
Yeah.
Great. So I guess we can change direction a little bit. I just want to remind the audience that are listening in, if they have any questions for our panelists, please feel free to type them into the Q&A box. So if we look at risk appetite across the equity market space and how you as investors assess companies at different stages, what are the different types of levels of risk that you're kind of interested in taking, and why, and how does that relate to early stage of the company, looking at exploration versus production, or the jurisdiction that you're entering, etc. So maybe Hedley, if you want to kick us off there.
Yeah, sure. Well, thanks, Amy. And the fund I work with, Line Selection Group, is a primarily early stage focused, sort of development oriented fund in mining. So we tend to see long periods in the market where a lot of the rest of the market is not so interested in where we might deploy. And then there's periods where they're very interested. So it sort of provides unique buying and selling episodes, if you like, that we can take advantage of. But and a lot of the investment market, if it's particularly it's managed in large buckets of money, it's concerned about risks like being able to get in and then out of a stock. So if it's a small company, liquidity is an issue. You can hold a lot of it and get it cheaply, but you might not ever be able to sell it. So it puts a blockage in place. As small companies get bigger, then that sort of rights itself. So I think that broadly speaking, over the last, say 3 or 4 years, the risk appetite towards small miners has massively improved. So we're seeing exploration get funded, which we've talked about very briefly here so far. We're seeing larger and larger capital raisings getting away, and we're seeing a re-rating of the capital in the junior miner space across most of the global significant exchanges for miners. So I'd say that there's been a pretty major adjustment in risk appetite, not only of how investors are prepared to behave as regards small companies, but also as to the kind of activities within those companies that they're prepared to back. And that theme sort of comes and goes. We've seen marijuana was a theme in North America. So medicinal marijuana, 2016 through to 18, netted quite a bit of money out of the market. And it was off the back of that and the investment appetite waning in that theme that I think investment in metals has come back in the Canadian market. And we've seen a real boon for that. So there's $4.1 billion, I think it was, raised by Canadian miners on the TSXV, which is their junior exchange, compared with just over $2 billion in 2019. So the amount of money raised doubled. The capitalisation of the sector almost doubled as well. Huge amount of money coming into that exploration side. So I think the way that investors are assessing risk is that they're happy to take some of those risks, around how risky the activity might be. Will you find something, won't you? Well, if you do, be a great payoff. So happy to take the risk. And I know it's a very generalised comment. Typically, when you start to see that behaviour in the market, you often see, are we happy to go into a jurisdiction that, which is more challenging? We've seen a fair bit of money invested in West Africa, just within the gold space, within the last few years. And I think that's been an exciting place to be involved. There's been some new projects developed. But I'd expect to see that risk appetite extend itself to other jurisdictions as well, some which haven't been classically so appetizing, as investors say, well, I'm looking for a cheap company in XYZ commodity, gold. lithium perhaps, and I'm prepared to go to a place that I might not have been prepared to go to before. So I think that's been a really interesting evolution of risk over the last few years. And obviously that's against the backdrop of how do you get a return out of equities generally.
Yeah.
I think from my perspective, we're probably on the opposite end of the risk spectrum to Hedley. We're a generalist small cap fund, so we do resources and industrials. We're much more earnings focused, so less likely to get involved in the front end exploration side, and more likely to get involved much closer to project financing and development. I think something David said earlier really hit the nail on the head, where there are a big class of investors out there at the moment looking for thematics, and they'll buy a basket of uranium stocks or rare earth stocks and actually not look very much at the company fundamentals. I think for us as, I guess, active managers at the moment, that's a pretty good environment. It generally means there's less dispersion between returns within asset classes, so you can find companies which are doing better things within their own company without just looking at what the asset class or what the commodity is going to do. And that's very much our focus. We're happy to take risk. We just need to size that risk appropriately. So we'll go to West Africa, we'll go to other jurisdictions, but those companies will naturally be a smaller part of the portfolio because it does carry a high level of risk. And what we're always looking for is companies with their own internal drivers outside of just the broader commodity cycle. So where's their production upside? Where is their potential M&A growth or other growth avenues that the market's not onto? So I think we take a lot more focus on company specific risk rather than just broader commodity or cycle risk, I think.
Yeah, I mean, maybe I'll just kick in there. I mean, what we probably invest between the two of Matt and Hedley. So essentially, we can invest in small explorers, the developers, and also the producers. And typically, we look for companies that either have a great asset, an outstanding management team, or represent, compelling value. Ideally, you want to find investments that have all those. And during periods of market dislocation, like we had in March last year, you sometimes find that, but most of the time you're compromising. But to give you an example, if you look at the gold sector now, we think there's value there, but the value is probably in the big producers that have come off more than some of the smaller ones. Whereas if you look at sort of the lithium sector or rare earths, you would argue that perhaps the bigger, more established players, valuations are stretched and there's value in the smaller. So to me, it's a top-down versus bottom-up kind of approach. You got to look at the commodities that you want to be in and then the best companies in those areas, given how the market's responded and how the market are valuing them.
Yeah, the point that I'd sort of add to this is that we're sort of of the view that we're at the early stages of a bull cycle for resources in general. Simplistically, as you move through any cycle, the risk tolerance of investors shifts down the curve as they grow greater confidence in the cycle in general, rightly or wrongly. Clearly we're seeing that play out at the moment to some degree, and you can see that in terms of the corporate actions, the capital management, the raisings effectively that we're seeing in this space in general. We the Global Resources Fund that we run here at Ausbil, we've taken a slightly different approach to investing in resources. We're long short. It's all about risk management from our perspective. We can manage the risk by removing commodity, country risk or otherwise by having shorts on the other side. When we like a bottom up opportunity, we can remove some of the risk within the portfolio as we have less confidence in a commodity or a location of asset or otherwise, which sort of we're comfortable taking on risk, but it's about understanding the levels of risk in each investment that's core to investing in resources in general. I think it's is your willingness to take on risk, and your willingness to protect capital, as you're managing your personal wealth or your your fund's wealth is core to this space in general.
David, I thought you made an interesting point there about, as you were saying, about the sort of spectrum of things that you guys can do from a size perspective, and talking about the comparative valuations, if you like, and where the opportunities might be. And with majors having, or sort of larger miners, I suppose you'd say, having come off maybe a bit more than some of the juniors have. There's a concept which I get approached by investors all the time asking me, how do you assess the value of this explorer? Which is a very, very difficult concept. I mean, you can assess the value of a miner based off of cash flows, and you can get those things very wrong because there's a commodity price which needs to apply itself, but you can take a view. And sometimes that helps you to spot opportunities when you know something might be cheap because, it's come to a low point in the commodity cycle, or perhaps they've finished their capital investment and then now comes some cash flow. But when it comes to explorers, you can't value them. You can only really price them. And the market tends to price those when a hell of a lot of money comes in, and when there's no money coming in, then it doesn't price them at all. So it's an interesting phenomenon which a lot of investors come along and want to play in that space, but they all tend to want to play at the same time. And when they do, it's a self-fulfilling prophecy as to what's going to happen with the price of a lot of those things.
Yeah, well, and I guess the point, the best time to invest in resources is counter-cyclically, particularly if you've got a positive long-term view, and lithium was probably in that space a year ago, and gold comes and goes from there. But you're right, with the flow of money, value doesn't stick around for long, and it's a matter of getting in when other people are looking elsewhere.
Value is often the midpoint, I guess. It's somewhere between the point where the market doesn't pay attention and when it does.
Yeah.
On the back of that, we have a question from the audience. It reads, a lot of EV materials and rare earth mining share prices have moved up a lot. Do you think the valuations are too high now?
I'll have a stab at that one. It's a tricky question. I mean, it kind of depends on the time frame you want to take in your investment horizon, and certainly it varies a lot between the different commodities because they all have generally the same demand drivers but very different supply pictures. Like Hedley pointed out before, a lot of these supply for these materials are step changes. So you have mines coming on which are 10-20% increases in supply, and that really can hit things around for a couple of years. I'll probably make the point that things have recovered quite a lot in general. I do still think we're seeing the underlying commodity prices in those areas move up, and there's potential for those to spike in the next 6 to 12 months as the world is short on supply. So there's probably nothing to say there's an imminent collapse coming. So probably well supported, but you do sort of need to take a view on this transition period over the next 2 to 3 years in terms of just how quickly EV adoption gets taken up. I think everyone agrees there's a great long-term picture there. But I think, look, that the period over the next few years where demand's a bit uncertain, does that ramp up parabolically or does it flatline a bit when you have all the supply coming into market? I think that's really going to determine returns over that time period. So it's a bit of a tough question to answer, and it kind of depends on a lot of variables. But short term probably okay, medium term mixed, and longer term fine. I think is probably my summary.
It's one of those questions which it's my least favourite question to get at a dinner party, and it seems to happen, or it might not be a dinner party. It could be on the sideline of my kid's cricket match or footy training or something like that. Some parent finds out that you work in mining investment, so all of a sudden they want to get your opinion on a mining IPO that's coming up or something like that. And I think David, it might have been you before, the best time to invest in these things is counter-cyclically. So the risk that you take when anything has a long positive or a sudden positive share price move is that you don't know when it's going to correct, and you don't really know what the value is that it's going to be oscillating around, because that can be a very difficult and arbitrary concept to nail in a valuation sense. So rather than answer, is the valuation too high of these things, I suppose the question that that person could be asking is how strong has the run been in any of these things, and why? And if it's because there's been a sudden, thematic shift in the market and you're buying into that theme somewhere beyond half and full time, perhaps, just be careful. But, have a think about the things which haven't had that move, and do you think that there's a fundamental that could support that in the future? And perhaps you'll have better value buying in those points. But the clear risk that you will feel like you're taking at that time is that going to move at all? So there's an opportunity cost and there's a risk in getting involved in these things that have quite volatile underlying commodity fundamentals, which is that you might miss the run. If you do catch the run, are you going to be able to take advantage of it? And were you in the right place at the right time and for the right reason? Quite often it comes down to luck. So sorry, there's some pretty discouraging answers in that, but you know, there is risk which presents whenever something has had a long run. But the most embarrassing answer that I've given to that is to say to someone, because I thought it was safe to say, you know, something that would protect a friend, is that's a shithouse IPO. You shouldn't be involved in it. And it goes from 20 cents to 45 cents on the first day of trading, and then they think I'm an idiot. Now, you know, that particular IPO went to 5 cents in the fullness of time. So I saved them destruction of 75% of their money, but they still see it that they could have more than doubled it. So, you know, there's a time frame aspect on that as well.
And Hedley, I'd probably say the least favourite question you get at dinner party is your view on Bitcoin rather than your view on mining stocks. But we'll leave that one aside. You know, I'd probably come back with this question in terms of, you know, your view on valuations of battery material stocks. Is demand going to slow anytime soon? I think the answer is no. Is there supply to respond in a near enough fashion that's going to slow things down? Sure, that there is over the medium term, but there's not enough supply in the near term to meet the requirements from a demand perspective. There's a whole supply chain that needs to be filled that's growing at an exponential rate that feeds into the demand backdrop as well. What's the solving item? It's price. Price is going to continue to strengthen for these core battery materials, sort of metals or otherwise, chemicals or otherwise, and that's going to feed into the valuations. Ultimately the backdrop is very supportive. And that wasn't an answer around Bitcoin. Apology.
Yeah.
Actually, I feel no danger whatsoever in answering questions on Bitcoin because I know nothing about it, so I can't profess to be an expert. And I don't know if there's anyone who could answer questions any better than I can.
It's not stopping anyone, mate. It's not stopping anyone.
We have another question from the audience that someone is interested on your view on the current shift in the interest in uranium stocks. I'm not sure if anyone in our panel wants to take that one on.
Can I ask, is that John Borshoff that's asked the question there?
It's an anonymous attendee.
So it probably is John Borshoff then. Uranium's a fascinating one because it's you talk about these inelastic markets. Uranium it's got virtually no spot market, and a lot of what gets sold is on long-term contracts. So when the uranium price moves, it doesn't necessarily re-enrich. Oh no, it's not John Borshoff. My apologies. This is the risk. I've got the Q&A question box open here. My apologies, not John Borshoff. I'd never seen the name anonymous attendee before, so I was making a mistake. When the uranium price shifts, it doesn't instantaneously re-enrich the producers because they might not be exposed to that price movement on a large scale of their actual revenue, but it doesn't stop the equity market shifting to reprice those. And probably where you get the most leverage is in explorers who haven't exposed themselves to any form of offtake. But equally, if you go looking for a gold deposit, we could find something which is quite small if the five of us wanted to form a company. And in all honesty, you can remove gold from the ground with a shovel and a pan, and you could sell it in the street in just about any quantity. Now, uranium is the opposite end of that spectrum in that you need to have defined production over a long period of time to be able to form any sort of contract to sell it to a bona fide off-taker. So, you can often see this uranium market is a long time coming, and then when it does come, it hits with a bit of a bang because when a demand interest hits the market, the supply response to it is muted and it pushes a lot of money into exploration. So I think this is a theme which has been a long time coming. Uranium sort of forays tend to play out over years rather than just a couple of months. And it can be quite exciting if you've bought before that. And hopefully we're only in the foothills of it. I don't know if that totally answers it. whatever anonymous attendee's name was, but good question.
All right, it almost takes us to the end. So my last question for the panelists is, we've talked a little bit about the intersection of ESG and EV materials and decarbonization. And I suppose a good place to end off is just kind of talking about how ESG is, how you see it playing into future investment decisions, and how you see it, I suppose, directing the resources industry as we move forward.
I'll start now, Amy. I mean, I think ESG is just getting more important by the day to the investment community, and it's just driven by the flood of money going into ESG products and where institutional investors and pension funds and the like want their investments going. So it's certainly a thing which is building, and it's not going away. It's kind of only getting stronger. I think companies are now sitting up and taking ESG a lot more seriously in terms of their disclosures. One of the interesting things we've seen has been the number of companies come out recently with, targets by 2030, 2040 when they're going to be carbon neutral, and they all kind of seem to rely on big new bits of technology which aren't quite there yet, like hydrogen and green steel and that sort of thing. So it's very easy for corporates to come out and say, in 10 years' time, we're going to be carbon free. It's going to be much more interesting to see how they actually track that and steps to get there, rather than just relying on things like hydrogen. I mean, I'm no expert in the space, but the work I've done suggests there's still a lot of technical and cost challenges in some of these areas to actually get them working. So I think it's probably a case of easier said than done at the moment. One of the other things we've seen with ESG and sort of sustainability generally, and this is across industrials as well as resources, is the price being paid for sustainability in companies is just getting higher and higher. So it's becoming much more of a trade-off now as to, do you want to pay a much higher valuation for a stock which has good ESG and sustainability credentials, or do you look further down the track, some of the dirtier stocks which don't necessarily fit ESG mandates but look very cheap? A few years ago, we were able to find companies with great sustainability credentials at good valuations, and that's kind of the sweet spot for us. It's really becoming a lot harder now, and it is much more of a trade-off as to how far you want to push the sustainability angle of the fund versus the valuation side. So it's the trade-off's definitely becoming much more noticeable, I've found this year.
ESG, I think, as a theme, used to be a nice to have. And I mean, it's not to say that companies weren't doing it well in the aspects that they were practicing, but it used to be a nice to have, but it's far more ubiquitous across the market now. And you look at most of the larger companies, and they've got to have a presence and a position on the multiple facets of ESG. And it's not just it's not just the way that they manage their environmental practices, perhaps. I mean, it applies to gender diversity. It applies to how the board is structured and owned, how the board owns shares in a company. But I think the ESG, like you said, Amy, there's an intersection with the green thematics, because if you are a company which is hoping to produce something which is going to save the world from carbonisation, that's better than using green steel for sure, as far as a lot of investors are concerned. So it really does capture some, I suppose you call them kudos. But I think that it's obvious that the money flowing into the sector has become far more concerned with that, and that must be because filtering down through all the layers of investors, they are as well. And whether they're investors who have that view themselves or the people they collect the money from have that view. I suppose you would say that enough is enough on a number of fronts, particularly environmental. We're seeing it in terms of gender diversity as well. Big themes in the market that companies are having to address now because of the pressure of their investors and that weight of money coming into their share price and wanting to buy them or not. But that also filters down. 5 years ago, junior companies did not talk about ESG. ESG meant cleaning up your drill pads after you drilled. But what it means now is that you've got to have policies on all of those things. So it's filtering down through the layers of the equity market into the juniors as well, which I think has got to be positive for the future. There will be a cost to it, but I think when you think of the way that the equity market relates to society, it's a positive impact overall.
I'll just add to that. I think ESG standards are having a huge impact on the investment landscape. And I think investors want ESG investments. ETFs in that space are exploding, and they're withdrawing funds from companies with poor ESG records and credentials, and actively seeking those companies that are at the forefront. And I think a company like Ausbil Minerals is probably a good example where in their projects they're building in solar, wind projects. The way they negotiate with Indigenous landowners, etc. It's more than just the environment. There's also the social and government kind of issues. So I think the resource sector, which you could see at some angle as being at risk of the environmental theme, I think there's opportunity there, and I think and you're seeing that a lot, and it's accelerating with Ausbil Minerals and Fortescue's announcement today, and Cooper Energy, for example, moving to carbon neutral. So I think there's an awareness there, and they recognise it's part of business going forward.
And then why don't I round out the discussion? So the way we come at ESG from a resources standpoint, there's obviously top-down factors that we're assessing and bottom-up factors that we're assessing, and the top-down comes to some of the discussion that we've had over the last hour. As you see energy transition, clearly that top-down discussion feeds into sort of issues around stranded assets, issues around commodities that are structurally challenged on a longer-term basis. The shift from fossil fuels towards sort of incremental demand that washes through in some of these other sort of newer commodities that we're discussing. So there's that top-down aspect. That doesn't mean that structurally challenged commodities won't have their day in the sun again, because they're not seeing the capital get reinvested. That there'll be periods that fossil fuels, whichever one they are, potentially will see spikes in pricing again, because if you're not investing in supply, if you don't have access to debt equity markets, then clearly it's supportive for commodities through the medium term before you see the demand destruction. And then at the bottom up level, we see ESG as a way to make better informed investment decisions. If you're looking at the mining space more broadly, safety is core, right? Safety is a great lead indicator for performance of mines, and we've seen that with what played out with Vale in recent years. But you see that at a smaller scale whenever you go onto site and have a look at operations, that generally low safety performance will give you a good read on how a mine's going to perform and how a mine operates. And then similarly, governance. Governance is it's just a massive driver for so how companies can unlock value or destroy value, right? Poor corporate governance by boards and management teams for mining companies, ultimately, similarly, is a bad lead indicator for performance of companies and management of companies more broadly. So we sort of come at things from both aspects: top down implications for commodities, and then the bottom up, and really enabling better informed investment decisions across the board.
Sounds good. And so that really wraps us up for this panel discussion today. I would like to thank all of our panelists for taking part, and all of our attendees for asking their questions. There were a few questions that we weren't able to get to in the time frame, and we'll try to address those later, either through the next event, which is happening in June. The next APAC event is happening in June, or through the assay. So please stay tuned for that. And thank you everyone for taking part today. We'll speak to you soon.
Cheers.
Thanks very much.